Hello and welcome back to my channel UK Pension Hub. Today we're covering an important financial update that affects millions of state pensioners across the United Kingdom. Revenue and Customs has issued a fresh warning that many retirees could soon be pushed into higher tax brackets as a result of rising pension income. This warning centres around an income level of roughly £25,000 per couple, a figure that could trigger unexpected tax charges if pensioners are not carefully managing all their different sources of income. With so many older people already feeling pressure from increasing household costs, energy bills, and general inflation, this new alert from HMRC is especially relevant as we head into the new tax year. This development comes at a crucial moment, with the Department for Work and Pensions preparing to apply the latest increase to the state pension through the triple lock system. Under the triple lock, pension payments rise each April by whichever measure is highest: inflation, average wage growth, or 2.5%. For the upcoming year, this increase is set at around 4.8%, driven mainly by overall wage growth across the country. For pensioners, this rise is undoubtedly welcomed, especially after months of financial strain, but the increase may have an unintended consequence. As income rises but tax thresholds remain frozen, more people could be quietly shifted into higher tax bands, without any deliberate change in their lifestyle or spending habits. Financial advisors have been quick to comment on the situation, urging pensioners to take a proactive approach. Chris Ball, CEO of Hoxton Wealth, is advising retirees to think more strategically about how they draw their income. He stresses that many pensioners accidentally pay more tax than necessary simply because they don't use their allowances in the most efficient way. Ball explains that people often draw money from their private or workplace pensions first, leaving their ISA savings untouched, even though ISAs offer one of the most tax-friendly ways to access income. Money taken from an ISA is entirely tax-free, including investment gains, interest, or withdrawals, which makes it a powerful tool for keeping taxable income low. Ball highlights that every individual is entitled to a personal allowance of £12,570 per year before income tax applies. For couples, this effectively means they can receive more than £25,000 tax-free, provided both partners use their allowances correctly. Yet many pensioners do not coordinate their income as a couple, leaving one partner with unused allowance while the other pays unnecessary tax. This situation is especially common among older households where one partner handles the majority of the finances. According to Ball, the key is to look at all your assets as one, rather than viewing each pension pot or savings account separately. Another concern raised is that once taxable income enters the higher rate threshold, pensioners could face a 40% tax charge instead of the standard 20% basic rate. For retirees relying on multiple income sources such as the state pension, private pensions, and rental property income, it can be surprisingly easy to cross into the higher tax band unintentionally. Ball emphasizes that proper planning can prevent this. Simple adjustments such as drawing less from taxable pensions and supplementing with ISA income can keep retirees comfortably within the basic rate band. These challenges are further complicated by the fact that once an individual earns over £100,000, their personal allowance begins to reduce. For every £2 earned above that threshold, £1 of the allowance is lost. Although this affects a smaller number of pensioners, it still contributes to the overall complexity surrounding retirement income tax. Meanwhile, nearly every form of pension income counts as taxable, from the state pension itself to defined benefit schemes, workplace pensions, and private pension drawdowns. Even rental profits from property ownership count towards the total taxable income, meaning that pensioners who rely on such income must be especially careful about how everything combines. Additionally, Ball notes that pensioners often forget that the state pension is paid without tax being deducted at source. Unlike wages, where tax is taken automatically, the state pension requires HMRC to adjust tax codes on other income to collect what's owed. If those tax codes are wrong, which happens more often than many realize, pensioners could underpay or overpay tax. An underpayment can lead to a large unexpected bill later on, while an overpayment means retirees miss out on money they could have used throughout the year. The triple lock increase adds another layer to the situation. Although pension rises are meant to protect older people against inflation, the government has kept tax thresholds frozen. As a result, pension payments continue to rise each year, but the tax system doesn't adjust to reflect these increases. This phenomenon, often referred to as fiscal drag, means that more people become higher-rate taxpayers even though their real income power might not actually improve. For some pensioners, the rise in state pension could be the final push into the higher rate band, especially those already close to the threshold due to private pensions or additional income streams. Financial experts recommend that pensioners review their full financial picture at least once a year. This includes examining pension withdrawals, ISA balances, rental or investment income, and how close they are to crossing tax thresholds. Annual planning can help pensioners adjust their withdrawal methods to stay within the basic rate band, avoid unnecessary tax, and make the most of tax-free allowances. For those unsure where to start, working with a qualified financial advisor can make the process easier and help identify opportunities for tax efficiency. Moreover, many pensioners have voiced concerns that essential living costs from council tax to broadband bills continue to rise faster than official figures suggest. Even seemingly small increases add up over the year and place extra pressure on fixed incomes. Because of this, financial planners emphasize that avoiding avoidable tax is more important than ever. Small changes in how money is accessed can create meaningful improvements in monthly budgeting and overall financial stability. One example often given is splitting withdrawals across different accounts instead of taking one large taxable lump sum, which can unintentionally push retirees into a higher band for the entire year. These small choices can make a significant difference. Preparing early is particularly important given that November's budget is not expected to introduce new tax reliefs for pensioners. With the government focusing on wider economic pressures, it is unlikely that additional exemptions or allowances will be created specifically for older people. Because of this, financial experts stress the importance of using existing allowances to their maximum potential. ISAs, personal allowances, and careful income management remain the most effective methods for reducing the tax burden in retirement. Pensioners who regularly check their income streams, stay organized with financial paperwork, and keep track of their tax codes are better positioned to avoid surprises and maintain long-term financial stability. This HMRC warning serves as a timely reminder that pension planning shouldn't stop once someone retires. In fact, it becomes even more important. The combination of rising pension income, frozen tax thresholds, and official increases driven by the triple lock means the tax landscape for pensioners is becoming more complex each year. Retirees who understand how their income works, who review their finances regularly, and who seek professional guidance when needed will be in a much stronger position to keep more of their hard-earned money. With the cost of living still affecting households across the UK, every pound saved on tax can make a meaningful difference to overall comfort and security during retirement. And that wraps up today's detailed update on HMRC's latest warning for UK pensioners. If you found this breakdown helpful and want more information on changes that affect your pension, your money, and your retirement planning, make sure to hit the like button, share this video with others who might benefit, and don't forget to subscribe to my channel.